Welcome to episode 14 of the Cashflow Connections podcast. The topic for today is controlling your future through self-directed retirement. To be honest with you, I think that self-directed retirement is probably the most underutilized investment vehicle in the US, so I'm very excited to get into this topic. First, we're going to discuss what self-directed retirement accounts are, how you can use them, and more importantly, how you cannot use them. As you'll tell from this interview, creating a self-directed retirement account allows you to essentially free your retirement savings and to invest it in pretty much anything you want. It makes you have almost entire control over those funds. However, with this power comes great responsibility. So we want to make sure you don't make any of these major errors, which are called prohibited transactions. Then towards the end of the interview, we have sort of a lightning round where I outline a typical situation and we discuss the preferable retirement structure for that situation. So I'll give you an example. If someone says, hey, I have a lot of money in my 401k, I just quit my job, what should I do? Now, keep in mind, of course, we do not give financial advice on this program. This is something you definitely would want to talk to your CPA about. We just kind of want to go through some of the typical structures and kind of give our reasons for that. And our guest does a great job of doing that. But just remember, this capital, particularly self-directed IRA funds, are very sacred. They're very special because they have preferable tax situations. So make sure to contact your CPA prior to making any choices, especially as it relates to self-directed retirement. Now, as some of you may have noticed, we did miss an episode. The goal has been always to have bi-weekly, every 2-week episodes. And we did miss one. So the reason for this is that things have been kind of going crazy at the offices of Cashflow Connections, which is great news both for us and for our investors. However, if you haven't yet signed up for an account, you're missing all the fun. So make sure to go to cashflowconnections.com, sign up as an accredited investor so you can get access to our available opportunities. Now, as an apology to the listeners out there, we are going to be putting out an episode every week for the next 3 weeks to catch up so we can get back on track. Those episodes have already been recorded, which is great, and they're all really interesting and on different topics. So I'm really looking forward to that. But just as a reminder, if you haven't yet signed up for an account, go to cashflowconnections.com, signed up as an accredited investor so you can get access to our investment opportunities in some of the least sexy asset classes in the country. Amazing. So let's get straight to the interview. How's it going, everyone? Our guest for today is Karen Hall, who is the founder and president of UDirect IRA Services, which is a self-directed retirement account custodian. Karen has more than 20 years of experience in mortgage banking, real estate, and property management, and is a regular speaker at some of the most well-attended real estate meetups in California. Through UDirect IRA, she has guided tens of thousands of Americans through the process of diversifying their investments using self-directed IRAs. So for all the people out there that have been asking me about this topic, how can I get started? How can I get set up? This is a great person to have this conversation with. So Karen, thank you so much for coming on the program today. This is a really interesting topic that I get a lot of questions on. So I'm really looking forward to this conversation.
Me too. Yeah. So what questions can I answer?
So let's start from a big picture. Let's talk about UDirect first. How long ago did you start this company? And when you started the company, what services did you set out to satisfy for your clients?
Right. Well, I founded the company in 2009, which was really, kind of at the height of the recession in a lot of ways. And at that time, people did not have access to capital. As you may recall, banks weren't lending. You just couldn't get a loan. Money was tight. And self-directed IRAs provide a way to tap into something like $24 trillion in retirement savings. So at that time, especially, self-directed IRAs were the answer to a huge problem, and that is access to capital. And that's how UDirect got its start, serving that need, and that's what we've been doing for these 8 years.
Got it. So this is not something that's always been around. From the self-direct retirement account planning perspective, when did this really become legal? And when have you seen the uptick in people taking advantage of this vehicle?
Right. Well, Gerald Ford signed the ERISA laws into effect in 1974. Then they went into effect in 75. And so ever since 1975, longer than a lot of the listeners have even been alive, 42 years, you've been able to self-direct your retirement. And the reason is because the IRS rules don't say what you can invest your retirement, your IRA into. They say what you can't invest your retirement into, and the items that you cannot invest your retirement into would be life insurance, like life insurance contracts, and collectibles. And a collectible would be something like collectible coins, or a fine wine collection, or an art collection, or collectible cars, or even diamonds are collectibles. So the IRS says the IRA can invest in anything except life insurance and collectibles. So there you go. And the real peak, again, of self-directed IRAs, I mean, it seems like it's peaking every year, but I think it really came to the forefront again in the recession. And the reason is because suddenly everyone realized, hey, wait, this is a way to access capital for our deals. And the reason is because all the other sources dried up.
Right. Yeah, that's a good point. So, mentioned that each year it seems that more and more people seem to be taking advantage of that. I mean, what percentage of the entire retirement account industry would you say is actually self-directed at this point?
I would say about 3 or 4% of
Wow.
all retirement funds are invested in what's called alternative assets. Yeah, it's still a small amount.
Wow, that's really interesting. So, just to be clear, I mean, for the listeners at home, you're going to understand by the end of this conversation that it's really possible to invest in virtually everything that you would be interested in investing in from an investment standpoint within these retirement accounts. And it sounds like less than 5% are taking advantage of it. It just gives you the potential to open up your investment portfolio and open up the planning for your retirement incredibly. And I think it's the most underutilized tool in the investment space. So let's get into some of the things people can invest. You mentioned a couple of things people can't, but there's far more things you can than you can't. So let's talk about some of the major vehicles people use when they're investing through self-directed retirement accounts.
Well, most of the assets that people use their IRAs for, their self-directed IRAs for, are real estate correlated, whether it's buying the actual physical property, commercial or residential. Maybe it's making a note, like investing in a trust deed that's secured loan against real estate. There are even unsecured loans that can be made with self-directed IRAs, or maybe someone's investing in raw land, or maybe they're investing in a syndication, and that syndication is then maybe investing in, say, a commercial building. So the IRAs, the actual asset the IRA holds is private stock, but the underlying asset of that private stock is then real estate. So that's what we see the most of. But, other asset classes include precious metals, like I mentioned, notes, private stock. Maybe you have a friend who's trying to start a company and trying to, maybe they've got a startup and they're trying to get going, and they need somebody to come in either in a debt or an equity position. Well, your IRA can lend the money in a debt position or become a member of an LLC in an equity position. So these are great, great ways that self-directed IRAs can be used.
That's a good point. And especially when you mention the debt component, one of the major benefits of investing in real estate generally is that there is usually some kind of tax deferral, right? So a lot of the cash flow is typically deferred. Some of the gains are taxed at lower rates than most people's income level that are investing in real estate. But see, with debt, you don't get that many benefits, similarly to the depreciation, for example. But with a IRA, particularly a Roth IRA, the gains can be tax free. So, debt is always an option. It's good to have both in your portfolio. So, self-directed IRAs make the debt investing a little bit more profitable, which is definitely a benefit there. Let's talk about some of the disallowed investments. You mentioned life insurance. That makes sense. From a actual investment standpoint, what are some of the options? You mentioned collectibles. So those are the types of investments. What about the types of transactions? Because I think that's where the real key is when it comes to prohibited types of transactions. So give us an idea of what prohibited transactions are and a few examples of type of transactions that people would not be allowed to make within their self-directed plan.
Okay. Well, with the self-directed IRA, I kind of think of it as a game of keep away. I like to use that analogy, right? Because if you're going to play a game, you want to know the rules, and this is a game of keep away. We're going to keep away from prohibited transactions. That's the object of the game. So I'll start out by explaining that some people are allowed to the IRA and some people are disallowed. So it's easier to talk the disallowed people about them. There are the lineal ascendants and descendants. So it's you and your spouse are disallowed to the IRA, but also your parents and grandparents and their spouses, and your children and your grandchildren and their spouses. Plus, anyone offering services to the plan, or possibly even a 50% business owner, could be a disallowed person. And then the people who are allowed to your IRA are out to the sides on your family tree, like your aunts and uncles, your cousins, your brothers and sisters, your unrelated people, unrelated persons. So that's a general way to think of disallowed parties. Now,
Okay.
the game of keep away, yeah. So then that really blends into the discussion of prohibited transactions, and they sort of break down into three basic types, and so we can talk about that. With prohibited transactions, first off, you're not going to have any personal benefit from the IRA today. IRAs are all about later. They're all about saving for later when you retire. So it's not about today. So you don't get to benefit today from your IRA, neither do any of those disallowed people. So your IRA does not make a loan to your son to go to college. Then a disallowed person would be benefiting today from the IRA, you see. Your IRA does not, basically, there's so many different things, but you can't, lend money to your spouse so that your spouse can start a business. Your IRA does not take personally any of the proceeds from the investment. So your IRA buys a rental property, say, and here the renter's paying the rent. They must pay their rent to the IRA that owns the property. That money must go back into this IRA that owns the property. And it can't go in your pocket. Then you would have personal benefit. It would be a prohibited transaction. So another prohibited transaction is that you or any of, your IRA can't buy, sell, or exchange assets between the IRA and anyone who's disqualified. So you don't buy a house from your dad. You don't sell a house to your children. You don't buy a house from your IRA. If your IRA owns property and you want it, you go out and get an appraisal, submit a withdrawal form with the appraisal, and then you basically withdraw that asset from your IRA at that market value, and we 1099 you for that. So another prohibited transaction that you're not allowed to do is that one of those disallowed people is not allowed to provide goods, services, or facilities to the plan. That's how it's written. And if you're a rule book kind of person, you want to see the rules, read Internal Revenue Code 4975. So it's IRC 4975. That's where it's written down. And so it's going to explain that, say, for example, your IRA owns a piece of property. You're not going to go in there and swing the hammers and, and change the garbage disposal, for example, because you're not allowed to provide services to the plan. In fact, if you do it, it's called an overcontribution of sweat equity, and it's prohibited. But similarly, for example, we had somebody who their IRA was buying a house. They gave us the purchase contract. We were reviewing the purchase contract. We got to the last page, and we saw that the selling broker, the broker of record there, was this person's father. So that's a disallowed person trying to offer services to the plan. Now, this father also wanted a commission on the deal, which would go back to number one, about them receiving benefit from the IRA. But they can't provide services even for free. So that father was not allowed to be on that transaction in any form, whether he received compensation or not. You can't provide services even for free. So that's a good way to think of it. So they're just called prohibited transactions, right? They're just, so it doesn't sound very serious because it's only prohibited. It sounds very, like, okay, it's not the big deal, but it really is.
Right.
Because and it's not like you can get easily caught committing a prohibited transaction. It's about, if you do, the IRS will disperse your IRA to you as a taxable event effective on the date of the infraction. So you may owe back taxes, you may owe penalties, and your IRA is suddenly going to become taxable to you. It's a big deal. It's going to be very expensive. Now, if you commit a prohibited transaction and it's a large amount, there is sort of a get-out-of-jail card, but it's not free. And it's called a private letter ruling. It's $10,000 just for the private letter ruling. Forget about the legal costs. But if you're looking at a huge tax bill and you believe that your transaction is legitimate and is not prohibited, you can hire an attorney and request a private letter ruling, which doesn't set precedent. It's private letter, right? It's private for that transaction. To try to get out of that prohibited transaction and the fees. So there you go. Prohibited transactions, we want to help you stay away from them. That's what we spend a lot of our time doing here, is talking to people and saying, okay, tell us about your deal. What are you looking to do? Or we're here looking at documentation as someone is proceeding to invest with their IRA, saying, okay, well, here's this purchase contract. Your father's the agent of record and is looking to get a $3,000 commission. This is, this is prohibited. So let's take two here on this. Let's redo this and make it so it's not prohibited.
Totally. I think that, that they gave several different options there and several different ways that people can kind of make this mistake. From a big picture perspective, the way to think about this is that this is a very special investment vehicle that is getting a tax advantage status to some capacity. So you want to be very careful with these accounts, and you want to treat those prohibited transactions very seriously, because the result can be very catastrophic if they take away your tax advantage status. So what I think of, like when I start to understand the retirement investing game, you realize that this money is kind of sacred, right? So you want to make sure that you don't make a mistake, but you start to think, okay, how can I really like inflate this account, right? Because it has this tax advantage status. So if you're not aware of what these prohibited transactions are, something that may come to mind is you say, okay, look, I am flipping a house. I'm going to buy the house for $5,000 with this Roth IRA. I'm going to spend the next 2 years painting the house, rehabbing the house, just doing all this stuff for free. And then the house is going to be worth $1 million, and I'm going to sell it and it's going to be tax-free. That's exactly the type of stuff. All the examples you just mentioned, that's one of the ways where people are going to make that mistake. Like similarly, you don't want to do something where you're saying, okay, how about, you get a friend and you say, I'm going to give you a screaming deal on this property as in that my IRA owns, and you give me a screaming deal on another property, and we can both inflate each other's Roth IRA. And so that's the type of stuff. But you got to be careful of that, because the truth is it's hard to prove it when it happens, because these are private transactions. The problem is that if someone finds out, you're going to lose that status, right? And so that's really the key. I think that this is something you mentioned a lot. If you have this control of your IRA, you have to take that control very seriously. So I definitely appreciate all those examples you gave there. One of the things you mentioned, though, was the fees and the way that you have to pay fees. So one of the ways that people may think to inflate the value of their IRA is if they are owning a property and paying the fees of that property out of their own pocket, as opposed to
Ooh.
having the IRA pay the fees. That's an example of one of those transactions as well. Yeah,
Yeah, don't
exactly.
do that. You don't, because if you're taking constructive use of your IRA, it's not an IRA anymore. Don't do that. At the best, it's an overcontribution. At the worst, it's constructive use, and it gets dispersed. So be very careful.
Definitely. You just touched on the overcontribution limit as well, right? So there are contribution limits for each income level, and then there's a certain level with Roth IRAs, for example, that you can't go above. So in the example there, if you are making the full contribution and then the property needs $100 window fix, and you pay that $100 out of your pocket, you have now effectively over-contributed to the Roth IRA or
Mm-hmm.
whatever vehicle you have. However, there's a difference, though, in the fees that are owed to like a custodian. So someone like a UDirect, right? So explain kind of the difference there between the fees paid in property owned by the Roth IRA as opposed to external fees related to the IRA itself.
Sure. So when a fee is paid and it's for the account, that is an account fee, and you can pay it out of the pocket. For example, your setup fee is paid out of pocket. You can choose to pay your annual fee from the account or out of pocket. Those kinds of fees can be paid outside the IRA. But if it's a fee for the asset that's in the plan, then it's different. If it's like your electricity bill on a house your IRA owns, that is going to pay for an asset. It must be paid from the IRA.
Got it. Okay, perfect. So I do have a couple of specific questions, and I know that you're very clear and you're not giving suggestions at all. So that's definitely, we want to be very
Right.
mindful of that, and that's the way the business is set up. But I do want to get your perspective on a certain specific questions in terms of what you typically see with the different structures out there. So let's say that you have $15,000 in a self-directed IRA, and there's an investment you're considering where the minimum is $25,000. From your perspective, would this be something that you can invest $15,000 out of your self-directed IRA, and then you also personally invest $10,000 to meet the minimum requirement? Would this be appropriate? Why or why not?
without advising. Let me just say this. Would I do that deal? Oh no, no, no. There's no way. And one of the reasons is because if the IRS comes to me and they say, "Hey, Karin, you did this deal, and part of it was personal and part of it was IRA money. Prove to me you didn't personally benefit from your IRA." How do you benefit? How do you prove that? You just don't, you can't prove it. Now, you're not really allowed to co-invest. And so to answer this question, there was a ruling, a Department of Labor ruling, DOL 2000-10, so 2 and 3 zeros dash 10, that says that if you want to invest in something and you don't have enough money, and so you dip into your IRA to bring enough money so that you can do the deal, you've just received personal benefit from your IRA, and it's a prohibited transaction. So that is something I would steer clear of.
Okay. From a big picture perspective, let's talk about a few different situations in terms of the optimal, like self-directed retirement. And if you feel comfortable saying, your particular strategy, not generally what anyone else should do, but just your perspective, that's totally understandable. Let's say that you're a college kid and you want to create a self-directed vehicle for yourself later in life. At that point in your life, what do you think is the vehicle in which you would go for creating a self-directed account?
Right. Well, if you're in college, you haven't had a lot of time to put away a lot of money. In fact, I have 2 college kids, and both my college kids have Roth IRAs right now, and they contribute so much a month, and they're building their own retirement savings. They don't have their money in self-directed IRAs yet because they haven't built enough money in their retirement accounts, in their Roth IRAs, to invest in anything that they're interested in. Plus, they're college kids, and they're not investing experts yet. They're not. They're specializing in what they're specializing in school, but when you're self-directing your IRA, you are the investment advisor, and you're going to invest in an asset class that you're familiar with. Well, when you're in college, you might not be there, but say you are. Say you've spent your whole life, your parents are investing in real estate every day of your life, and that's how you've been raised, and that's what you want to do. I mean, knock yourself out. But when you're building an account, there are ways to do it. I mean, when you're trying to build an account so that there's enough money in there to actually self-direct into an asset, obviously you want to contribute every year. If you're, again, back to the college student, you're allowed to contribute $5,500 a year to a traditional or a Roth. And so you can max out that contribution every year, so long as you earn that much money. You can't contribute more than you earn. But if you earned $5,500 in a tax year, you can contribute $5,500 in a tax year. Keep on saving. So you want to save as much as you possibly can. That's A. But when you go to find an alternative asset, you have to do your homework and make sure that it's an asset that's going to be an asset that pays off for you, that's going to be fruitful for you. And that's how we see people build accounts. And I think that addresses your question. If it doesn't, let me know.
No, that's exactly what I was looking for. In fact, I'll just add in a little anecdote. When I was in college, I DJ'd through college, and one of the reasons I DJ'd is so I could have the income to make a contribution to my Roth IRA. So we tried to make exactly $5,500 a year. Quite a successful business. Okay.
Excellent.
Yeah. So let's talk about another situation. Let's say that you're 35, you just quit your job, and you have some 401k money from that job, and this has usually been invested in traditional investments. What would be your typical course of action if you want to take more control over that 401k money? And this is a situation I hear very frequently.
All right. Well, let me see if I am grabbing this. So if you've got a 401k at your company where you're working, right? You don't get to really take control of that. It is a plan. It's an employer sponsored plan. You won't be able to self-direct that money. And you have to look at the plan document that says what you can and can't do. But an employer has a fiduciary duty to its employees to make sure that they're investing in safe assets, apparently, which is kind of weird given how volatile the stock market is, and alternative assets are considered more volatile. So you can, as an employer, you could run into some risk allowing your employees to self-direct. Does that cover it?
Yeah, sure. And then let's say that you quit that job. At that point, is there more options?
Then there you go.
Yeah.
Yeah. Yeah, then you can roll it over. Then you can roll once you've left the service of the employer, you can roll it over. And this is true too for people like in the military. If you're in the military and you've got a thrift savings plan or a 457, or maybe you're a nurse or a teacher, you have a 403b, and you want to self-direct any of that money, it's the same thing. You really have to wait until you leave the service of your employer before you can roll that money over. But you can certainly roll it over as a custodian to custodian transfer, and it's not taxable. When it's, when it doesn't touch your hands, it goes just from custodian to custodian, it's not taxable.
Yeah, that's an important distinction. So typically speaking, if you're going from a 401k, the most typical route is to go from 401k, if you quit your job, to convert that to like a traditional IRA. Now, if you
we would say rollover. I mean, if you want to use, we convert, would refer to like a Roth. I mean, just if you want to know my the jargon of my world, a conversion refers to a Roth conversion. There you go.
Okay, perfect. And the key there is that if you do convert it, as you say, to a Roth, that is a taxable event because you're kind of changing the overall tax status of the account.
Absolutely.
So that's something you want to be mindful of. And then, something else that comes up a lot is people say, hey, I quit my job. I've got my 401k money. I can just withdraw this money now and have access to it. What are your kind of thoughts on that strategy?
Well, yeah, you can. You're going to get taxed on it, and if you withdraw the money from a retirement plan, you're also probably going to be penalized if you're under 59.5. So it's probably going to be the most expensive money you ever had access to, but you certainly can. It's your money, but you will face tax and penalties.
And boy, do people do it. And it's because of the fact that I think it's because of two things. I think it's that they don't fully grasp the specialness of those type of accounts, but they also don't have, a custodian like UDirect that allows them to kind of take advantage of all the great investments out there in the world. So if you're listening at this home and you just quit your job, please take a listen before you withdraw that capital. It's something that is quite, I think, like I saw really ridiculous statistics recently. I don't want to misquote, but it's a high number. It's higher than we would hope. Okay. Next situation here. So let's say you have a business and you make a significant amount of money each year. Don't have any employees, but you're a solo entrepreneur. What is the preferred self-directed retirement vehicle for this type of situation?
Well, you're going to have to take a look at your situation, but there are a couple of them. One of them is the SEP IRA. SEP is an acronym for Simplified Employment Plan. What it really is a traditional IRA on steroids. It's got the traditional IRA platform, but as a self-employed person, you're allowed to contribute more to that kind of a plan. Right now, you can contribute 25% of your income, is part of it, or up to $54,000. So the lesser of 25% of your income or $54,000 can be contributed to a SEP IRA, and the SEP IRAs have low fees, and they really are simple. Now that's interesting to call it simple because there's also something called a simple IRA, but the word simple is an acronym. It's another kind of IRA that's for self-employed people. That's an acronym for Savings Incentive Match Plan for Employees. So the SEP IRA, you can contribute up to $54,000. A simple IRA, you can contribute up to $12,500 if you're under 50. And then, there's a catch-up contribution if you're over 50. So the simple IRA has a lower top, cap of contributions. The SEP IRA, you can, again, contribute $54,000 max. Now, there's another kind of account that isn't an IRA. It's called a solo 401k. A 401k, you know what a 401k is when you work for an employer. You sign up for it, you contribute out of your paycheck, and you the money goes into maybe mutual funds or some sort of the stock market or something like that. But with a self-directed solo 401k, first off, the solo 401k implies that you are self-employed with no full-time employees. I mean, you can have some part-time employees as long as they don't work over 1,100 hours a year, but no full-time employees in any of the businesses you own. So maybe maybe you're a DJ and you've got a DJ business, and maybe you also went out and bought a dry cleaning store. You can't have a single full-time employee in any of your businesses to qualify for the solo K. But the contribution limit is the same as the SEP. It's 25% of your income up to a cap of $54,000 a year. But you want to think about that because the calculation of how you arrive at the number you're allowed to put into either account is different, and you want your CPA, your tax person, to calculate that for you. So there's that. But with a 401k, a solo 401k, lots of bells and whistles. For example, in the IRA world, you cannot borrow from an IRA, but in the 401k world, yes, you have a solo 401k established. You can borrow from it for personal use, $50,000 or 50% of the account, whichever is less. So that's a huge advantage to the 401k over the IRA. When an IRA is investing and borrows non-recourse money to invest, the IRA owes a tax called UDFI, and that's another story, right? But when you go over back into the 401k world, this 401k can borrow non-recourse money to invest, and the 401k does not owe the UDFI tax. So it's another advantage. So higher contribution limits, you can borrow from it, you don't pay the UDFI tax, and there's more, that you can. Reasons to do a solo 401k. So those are three different plans for self-employed people.
Wow. Okay. Those are all tremendous. And for those of you that haven't been exposed to those, those contribution limits are quite high, meaning that you can create a significant account for yourself very quickly, because of the fact that those are structured for that exactly that, to really incentivize business owners to really supercharge their retirement. Now, do either one of those examples you just have, do any of them have a Roth option or a Roth component?
It's only the solo 401k that has what we call a Roth bucket. So with the solo K, there are two parts. You're wearing two hats when you're self-employed. You're probably wearing more than that, but you're the employer and you're the employee, and that's how it looks in the 401k. So the employer portion is going to be pre-tax, like a traditional IRA is taxed, similar to that, so it's pre-tax. But the employee bucket, it can be Roth IRA, and the contribution limit is $18,000 if you're under 50, and there's a catch-up contribution, so it's $24,000 if you're 50 plus. So that employee bucket of the solo 401k can be Roth. Unlike the regular Roth, where if you make too much money, you can't contribute at all to a Roth, in the Roth bucket of a solo K, back over here in 401k world, on the other side here, you can make an employee Roth contribution regardless of your income, and it's the contribution amount is practically 2-3 times what a regular Roth is. So another huge benefit to a solo 401k.
Got it. Yeah. And just for the listeners, so typically speaking, Roth or Roth component plans allow you for the gains within those plans or buckets, as you say, to be tax free, the gains to be tax free, as long as you take distributions appropriately. So what that means is if you have $100,000 invested and it turns into $500,000 over the course of the 40 years that you're investing, which is possible, that $500,000 would be tax free. Now, with the traditional money, you are taxed when you take the money out. The money that you're taking as a withdrawal is taxed at your income level at that point. So I have always made the argument that I just really prefer the Roth component for a lot of reasons. And one of which is that I'm pretty confident that the tax brackets are going to be higher later. And I'm hoping that I'll continue to be in a high or higher tax bracket later in my life. Now, some people, that's not the strategy or that's not the way they see things. But I'm always willing to pay taxes now as opposed to pay taxes later. And I know that sounds kind of counterintuitive, but that's my justification for that. I don't know if you have any thoughts you want to add to that, or if you think I'm off there. I'm interested to hear.
No, I think a lot of people feel the same way you do, and I don't think anyone thinks we're going to pay less tax in the future. So no, I think you're within the majority. So where you have these contribution limits, how much you can write a check for and put in your account. The great thing is there's no cap on how much your IRAs can gain from investing. So that's why Mitt Romney has this $20 million IRA, because it just grew and grew and grew, and there's no cap on the growth, only a cap on the contribution.
Right. Now, with that in mind, let's say you do have a Roth IRA. Let's say you set up a Roth IRA when you're in college, you've been contributing to it. Now, if you start a business and now you have your solo K, how are these contributions counted in terms of making contribution to both the Roth IRA and the solo K? I mean, how does that kind of work? And is it plan dependent?
What do you mean counted? How are they
I guess
counted?
in terms of the contribution limits. So can you make the $5,500 annual contribution to your Roth IRA and then may make a
Hmm.
or make the $54,000 max contribution
You
to your solo
can.
K?
Yeah.
Okay,
Yeah,
got it.
yeah, and you want to do this under the, you want to talk to your tax advisor, and you want to have your tax advisor in on this. And first off, because your tax advisor is going to calculate your solo K contributions, and you want them to understand what you're doing so that they make sure that you receive any tax benefits that you're due while you're doing this.
That's a good point. And for all the listeners, please, this is, like I said at the beginning, this is sacred money. So you don't want to make a mistake. And a very small mistake can be a very much of a headache. So make sure that you do talk to your CPA before even creating one of these accounts. But we definitely wanted to discuss the topic from a big picture perspective. With that in mind, with the whole control versus power versus responsibility, there's a structure out there that is sometimes, I guess, it's not as common as most traditional, but I definitely hear about it mentioned, which is that someone opens a self-directed IRA and then they open an LLC, which they themselves own. And then that self-directed IRA invests 100% of its assets into this LLC. And now all of a sudden, the person basically has full control over their self-directed retirement account in the sense that an intermediary, a custodian, is not directly related to the kind of overseeing the documentation and the funding. What are your thoughts on that
Hmm.
structure? And what are some of the benefits or the downsides?
Yeah, yeah. There's just one little hitch in what you said. So when it's your IRA that opens up the special purpose LLC. Now, you don't have any personal ownership interest in that LLC. You don't set it up yourself. Super important, because your IRA can't buy an asset that you own. So if you set up an LLC that you own, your IRA could never buy it. It would be a prohibited transaction. So what you do is you get your self-directed IRA open and funded. You have a third party create this special purpose LLC. It's not the kind of LLC you're going to use that you would use to run a business. It's not like that. It's a special purpose LLC that's designed just to hold IRA funds and has special language in it. And by the way, the legal case that was a precedent for this was Swanson v. Commissioner in 1996. If you want to, one of those rule book people, if you want to look it up, there you go. That's where you can look it up. But your
Perfect.
IRA buys 100% of the initial units of that special purpose LLC. Great. So the money goes from your IRA into the checking account of this new LLC, right? So your IRA has an asset, your LLC has the money. Think of it like there's this big umbrella, and the umbrella is the IRA, and the LLC is under that umbrella, because you can't have the LLC without the IRA, because everything reports back and reports through the IRA to the IRS. So with great power comes great responsibility. Now you've got this IRA-owned LLC, oftentimes called a checkbook IRA, which can be confusing, but that's the jargon for it. And now you get to write checks, and you also get to sign things on behalf of the LLC. So your IRA is making offers on property. You're signing those offers. If you didn't have the LLC, we're signing all the offers on behalf of the IRA. So you see, it gives you a little freedom there in just signing. Maybe your IRA has purchased a house, your IRA-owned LLC purchased a house, and now you're fixing it up, so you're paying vendors. You get to write all those checks out of your checking account. Maybe you're investing in tax deeds, and you get to write all those checks out of your IRA-owned LLC's checking account. But what's not happening when you have this LLC is those transactions are not flowing through the eyes of my staff and I to review them to see if they're prohibited transactions, and they very well could be. It's easier than you think to commit a prohibited transaction. So can you use an IRA-owned LLC? Yes, they do still exist. They're allowed. Does the IRS, are they under special scrutiny? Well, maybe they are, because a couple of years ago, the IRS changed a couple of the forms that we used to report IRA information to them. So they changed the 5498, where we report like deposits and value to the IRS, and also the 1099, where we report distributions. So these forms that I just mentioned now have a little box on them where we're supposed to tell them what kind of asset is in the account. Previous to this, for 40-something years, the IRS did not know what kind of asset was in the account. Now they do. So you have a single member LLC in your IRA. Now the IRS knows that. And if they want to come calling on you, if they want to start doing an audit and picking some low-hanging fruit, they might just decide to audit everyone who has one of these IRA-owned LLCs to check for prohibited transactions. I don't hear that it's happening per se, but it could, because now they know who has one. So just remember that with great power comes great responsibility, and that's why we're here. Hey, Karin, I'm thinking about doing this deal. You reach me, info@udirectira.com, super easy, and say, hey, can I talk to you about this deal? And we'll tell you what we think. If you need legal opinions, we can send you to some attorney. We have a list of a few of them that specialize in self-directed IRAs who can maybe give you an attorney opinion letter if you need it, so that you can go forward with confidence, feeling like, yeah, this is a good deal. That, it seemed a little gray, but now I got this attorney opinion letter and I feel good, and I'm going to proceed with this deal. So you just want to, again, it's a game of keep away from prohibited transactions. If you just remember that then you'll play the self-directed IRA game real well and you'll win.
Awesome. I really appreciate the explanation and the clarification. So you can tell that I actually don't utilize that structure. So I'm glad that you could help me there to kind of clarify my own thoughts. We definitely covered a ton of information. So I really appreciate you coming on. I know that the listeners learned a lot. So if you want to leave your contact information, just let us know where we can contact you.
Excellent. Well, you can contact me. The best way is to go to our website, which is the letter U, udirectira.com, and that website is full of information. We have a toll-free number, and it's 866-447-6598. And, you can email me anytime at info@udirectira.com. So it's a letter U, udirectira.com. We're on Facebook, we're on YouTube, we're on everything, so social media. So it's very easy to connect with us. We have live chat on our website. So, we really want to talk to you about your self-directed IRA ideas and plans and help you with an account.
Awesome. And I rarely give actual referrals, but I can tell you I've been a client with those guys for quite some time, and I have referred several clients to them. So I really appreciate it. And thanks again for coming on.
Oh, Hunter, thank you so much.
For all the listeners out there, hope you enjoyed that episode. That's definitely a rare opportunity where you can get into the details of some of these different retirement plans with someone that is that knowledgeable on the topic and has a lot of experience in real estate, so they can kind of view that from that perspective. So if you want to reach out to UDirect, their website is udirectira.com. They have a contact form there. They also have their info@udirectira.com email address that's readily available. Also, for those listeners that haven't gotten connected with me yet, I'm always interested in networking with new investors. Don't hesitate to reach out to info@cashflowconnections.com. I'll shoot you an email with my scheduler. I'd love to get on the phone for 30 minutes, discuss your strategies about investing. What are you seeing in the market? And I can talk about some of my strategies as well. You probably have a good idea from listening to these podcasts, but usually the podcasts are having guests on. So my strategies come across in some of the questions I ask, but I'd love to hear about what you're seeing in the marketplace. So don't hesitate to reach out to me directly at info@cashflowconnections.com. Thanks a lot.